everyone, welcome to this tutorial video going through a bit more detail on variable mortgages. So we'll explain the different types of variable mortgages and why these payments may be different even though the mortgage size is the same, the amortization size is the same, and the rate is the same. So this is really key information for consumers and for mortgage brokers as well. So as a quick refresh, variable rate mortgages, when you're securing a variable rate mortgage, what you are securing is a discount in most cases or a variation from the prime rate. So the prime rate right now, as of September 2025, was just the Bank of Canada just dropped this to 4.7. So this is the prime rate. So what you'd secure is a difference from the prime rate. So whenever this prime rate changes, that difference remains the same. So let's say it's prime less 0.5. So we'll add that in here, and then the net rate is 4.2. If there's any changes in the Bank of Canada's overnight rate, all the prime rates do update accordingly. Now, one thing to note as well is lenders, they do automatically update their prime rate, but some lenders do this at different frequencies. For example, Scotiabank may wait till the end of the month. Sorry, let me just make sure these are the same. Scotiabank may wait till the end of the month to do this. Some lenders do it the next day. So just it's not done automatically, although they do it. They will update their own prime rates. So just letting you know if there's any delay or you're looking at your mortgage and thinking, why hasn't this updated? Lenders do this at different timescales, but the rates will update. Their prime rate will update when there's any changes in the overnight rate. So now comparing the variable, so the VRM and the ARM. So you'll see there's a couple of key differences here. So the VRM stands for variable rate mortgage. The ARM stands for adjustable rate mortgage. So that's the terminology. So you'll see a couple of other differences here as well. So when it comes to the true VRM, the variable rate mortgage here, there's a lot of the banks do have these. So your likes of RBC, CIBC, they will be a similar product to TD. Scotiabank is a bank, one of the few actually that does the adjustable rate mortgages. A lot of the monoline lenders will offer these adjustable rate mortgages as well. And the key difference between them is what happens when there's changes in that prime rate. So what we can do, and also just shouting out Tactical Mortgage Solutions, the tool that we are using to do this demonstration. So what we'll do, let's just put so we can just plug in a forecast changes here, and then we can see what happens when there's changes in the prime rate. So let me just put these in here. So we have these automatically saved, so we can just use these as an example. So you can see here, if we look at the amortization schedule, so for the VRM, you can see here, okay, so the rate 3.95. When that changes, when that rate comes down, you can see the payments stay the same. What changes is the amortization. So the impact of this as well, let me just move my face higher there, is the principal increases with the rate decrease and the interest decreases. So essentially the client is paying down the mortgage quicker, but their payments stay the same. So when we were in the times of COVID, when rates were going up to sort of 6-7%, clients that were in these types of variables, their payments didn't increase, which sheltered them for a cash flow perspective, but the interest that they were paying with each payment increased because the amortization was increasing. And there is a certain point where, this is called the trigger point, where you reach the point where your rate is so high that the mortgage payment no longer covers the interest that's owed with each payment. So that explains a little bit about what happened there. So in an environment where rates may be going up, this can be a strategy to help with clients that may be fearful of the variable because of their payments changing. With these variables, at least if there's changes, their payments stay the same. It's just the speed that they pay down the mortgage and the interest with each payment effectively that is changing. So if we exit this, and then we'll show what happens with the ARMs. So if we look here for the ARM, so here we can see the amortization starts the same. When that rate comes down, you can see the payments come down, but the amortization stays the same. So with that drop of 0.25, you can see here the payments actually decrease to keep the rate they are paying down the mortgage the same. However, of course, the opposite of that is true. If rates go up, then payments will increase significantly as well. So that is one of the sort of potential benefits and risks. So some clients may want their payments to come down with changes in rates, but they've also got to be aware that payments may go up with changes in rates as well. Now, the other key thing to bear in mind with these mortgages here is the compounding is slightly different depending on whether it's a VRM or an ARM. So for the VRMs, the mortgages are compounded monthly. For the ARMs, they are compounded semi-annually. So why does that make a difference? So you may remember at the beginning of this video, so let's just remove these prime rates. So we're just looking at like-for-like comparison here. So they're both at prime less 0.5, and let's just remove this from this section here as well. So they're both at prime less 0.5, but the payments are different. So the reason the payments are different is because of the compounding. So the monthly compounding is actually more expensive. So the way that interest is compounded is it's something that often is overlooked, but it is important when you look at what a client will be paying. So if we scroll down here, you'll see over this 5-year term, it's actually $882 cheaper, even though the rate is exactly the same, to choose the adjustable rate mortgage. So if you're competing against or if you're trying to compare to one of these VRM options, you can actually say, listen, even though these rates are the same, you're actually making interest savings here. So let's just, if we play around with this, let's just reduce this discount and see if we're still ahead. So if we look at that here, so 4.22, so you're still ahead even though this rate is higher. So that's why also it's not just about the rate, it's about how the interest is compounded. So now you can see that the difference of 0.04, so let's just say, if I'm just playing around with the numbers here. So you can see even though the rate is 0.03 higher, there are still savings, everything else remaining the same if there's no changes in the prime rate. Choosing this option because the interest is compounded semi-annually. You can see the payments are slightly lower, your total payments over the duration of your term, outstanding balance is lower at the end of the term as well, and then the total savings of 165 there, even though that rate is slightly higher. So those are just a few tools in your toolbox to really explain those differences between variables. Once you get into a bit of the detail here, some clients really do have preferences, not only on the rate, and you can just show them that actually even though the rate's sort of the same or slightly higher, it may be where you can save interest. But that key difference of whether your payments change or whether the amortization changes with changes in prime rate may be something that's really key and important to your clients. It may even be a reason if you strongly feel a variable is a good option for them. It may be, and you have more competitive options on the variable side, it may be an option that would allow them to choose the variable because they know their payments will stay the same, as opposed to a fixed. And again, it's one thing I haven't mentioned, one of the main benefits of a variable over a fixed as well is the penalty is only 3 months of interest. So if a client may move within their term, if you're uncertain about the future or predicting rates may come down, then the variable does provide that extra flexibility with the much lower penalty than the fixed as well. So I hope that helps explain some of the differences. The key differences here between the VRM and the ARM for mortgage brokers, and this is an extra tool in your toolkit when you're talking to clients to add value. And again, the tool I'm using is Tactical Mortgage Solutions. It's a tool we use with our clients. I'm an investor in the product, and I really love it for showing. We go through these types of discussions with our clients as well, and it's always super useful and can really add value in anyone you're dealing with. So any questions or thoughts, do leave them in the comments. And if you enjoyed this video, I'd really appreciate it if you like and subscribe as well. And have a great rest of your day.